Adrian Mowat, Chief Emerging Market and Asian Equity Strategist with JPMorgan joins us. Adrian, great to have you back on ET Now. Thank you for joining us. Adrian, today it's all about mean reversion, but do you think it's a matter of maybe 2 or 3 days this sell-off will, run its course?
Yeah, I think this sell-off will prove to be a buying opportunity. As your previous guest was highlighting, we have a central bank in the world's biggest economy that is tapering because they're confident about macroeconomic growth. The U.S. is growing above trend. I think that will continue throughout 2014. That is fundamentally bullish for emerging market equities. And to have equities and speculation on currencies being focused in places like Turkey, which is 1.5% of the EM benchmark, or Argentina, which isn't even part of the EM benchmark, I think is events that provide opportunities because they're really fundamentally rather irrational to try and extrapolate problems in these countries to what's going on in the balance of emerging markets, particularly emerging Asia.
Adrian, do you think part of the concern for global equities right now is also the Chinese PMI data and that it is not, or rather hasn't been strong for the last couple of times?
Yeah, I think you're right to focus in on China as an important source of risk for EM. China is 20% of the EM benchmark. It's just under a third of EM GDP. So how China performs is important. But it's very important to understand how the Chinese economy really is developing. China looks like nearly every emerging economy towards the end of its high growth period. It's had to resort to debt and investment-led growth in order to maintain high growth rates. That isn't sustainable. The Chinese economy will continue to slow down. What's good news for equity investors is the Chinese equity market already tells you that the banking valuations are very, very low because the equity market doesn't believe in the current growth model. So, I see China as an economy that will continue to slow. They'll probably have to have another mini stimulus. And, that may weigh on people's enthusiasm for EM. But if you look at what's priced into equity markets, I think we're already there.
So would U.S. auguring well, China going down, how does it stack up for emerging markets in particular like India?
Well, you see, it's actually quite a nice environment for India. India's terms of trade will continue to improve as commodity prices weaken, reflecting weaker demand out of China. And India tends to be more exposed to European and U.S. demand for its exports, particularly its exports of services. The IT industry really a direct play on what's going on in the United States. So I think the combination is profoundly bullish for India.
Adrian, like you said, for the moment, India is not on the top of the risk scale. But should one be wary about cracks which are opening up in other emerging markets like Argentina, Brazil, Russia, and to a large extent Turkey?
I think the answer to that is no, you shouldn't. There are fundamental issues in Turkey that are resulting in weaker economic growth. It runs a very large current account deficit, more than 7% of GDP. So if you've got weakening growth, a large current account deficit, it is difficult to attract equity capital. And in order to attract bond flows, you need to offer higher and higher interest rates, which is effectively what CBRT was doing yesterday. And in offering higher interest rates, it has a negative impact on the equity investors in that you slow down growth. So I see these as specific issues, and the smart money will use it as an opportunity to buy into the markets that don't have those fundamental problems but are being sold off for the wrong reasons.
Adrian, I don't want to get this one wrong for our viewers, but you don't have a hedge view on India. You, in fact, have a bullish view on India, and you are of the view that buy India on every decline.
Yeah, I have a view that you should be bullish emerging market equities. You should be long Korea, Taiwan, India, Mexico, Thailand. And you should also be bullish EM fixed income. My colleague Joyce Chang, who does fixed income strategy, she's just upgraded EM debt to overweight. There's a lot of value in this asset class, and there are many irrational fears, and we see the diminishment of tail risk perception as being a very important driver of EM equities, and that includes Indian equities.
Adrian, what's your sense when it comes to IT as well as pharma? Because these are two sectors when it comes to Indian equities that have really withstood, any sort of market environment. Do you think in future as well, IT and pharma would continue to be beneficiary for investors?
Look, I think you have to look at those sectors very specifically. Look, they're beneficiaries in terms of a weak rupee as exporters, but the IT story is maybe one that's more common across the companies. Within the pharma space in India, you've had some very poor performance. If you fail to get FDA approval for your factories, that's not very good for the story. So the other thing I'd highlight about Indian pharma, I often get asked about it, it's such a small part of the global benchmark that it isn't particularly relevant. Korea, Taiwan.